Good morning. This is Dylan Jovine with Behind the Markets. Happy Tuesday. Today is Tuesday, August 26th. And I just read that a library book was returned 82 years after it was borrowed from the San Antonio Public Library. And it came with a note stating that, quote, Grandma won't be able to pay for it anymore. And this book was borrowed April 13th, 1943, and it was just returned. Isn't that interesting? I guess you wanted to return that. Make sure that you cleaned any outstanding issues. So you made sure you did that. Anyway, today I want to talk about the Fed. There's so much to talk about. The government taking a stake in Intel, SoftBank's Intel investment, so many things happening. But today I want to talk about the markets and the Fed because Fed Chairman Powell gave his last speech at a very famous annual Jackson Hole conference. He gave his last speech as the chairman of the Federal Reserve last week. And he didn't push back against all the desire for an interest rate cut. And I'll tell you something, if you're interested in finance or the markets, I'm telling you, the text of his speech is definitely worth reading in full. But the key phrases were this, I wrote them down. Quote, downside risks to employment are rising. And quote, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance, end quote. So in English, yeah, it might be a good idea if we were to cut rates, which of course ignited a rally for both stocks and bonds. We saw that. On the very charged question of whether tariffs will stoke higher inflation, Powell said there's a reasonable base case for that. Or maybe it's a one-time shift. There's a lot of debate about this. So we will see. It's basically been the tariffs policy that has kept the rate cuts on hold, basically. Anyway, so that was really good news for the market. And right now we see the Bureau of Labor Statistics basically adjusted their jobs report so dramatically that it basically changed the whole conversation here. What they're saying basically in English is the labor market is weak. We're going to have to cut rates, probably going to have to support the risks. So the Fed has a dual mandate, price control, because you don't want the value of a dollar to decline by more than 2% a year. So they accept 2% inflation, basically. So it's a managed decline, 2% a year inflation. So price control is one mandate, and the other mandate is employment. So it's a dual mandate, okay? So for the past several months, he's been saying, we got to see how the tariffs work out. And now he's saying, well, the risks to employment, this is it. This is how you drive the car. They have a dual mandate. What are you going to do? So you got to drive the car thinking about both of these things. And the Bureau of Labor Statistics report shows that, that you got to worry about this. Now, let me tell you something. Just a little piece of history from Carson Investment Research and FactSet Research. When the Fed cuts interest rates within 2% of a stock market all-time high, the S&P 500 has gone on to finish higher over the next 12 months, 20 out of 20 times. So it's a 100% hit rate. And I will tell you something, the average return over the next 6 months is 3.4%. We're still in a bull market, obviously. And this goes back from 1980 to 2024. So basically, we see that 20 times the Fed has lowered rates when the market has been near an all-time high, and the market has gone higher over the next 12 months. That is really good news. It's very good news. And why does the market do that? You remember something. First of all, what's going to happen now? Remember, there's an inverse relationship between interest rates and stock prices and all asset prices. So interest rates go down, asset prices go up. Interest rates go up, asset prices go down. It's like a seesaw relationship. And a lot of folks understand, or they're going to say to themselves, you know what, he's going to lower rates probably 1 full percentage point, which was 100 basis points, which will probably send asset prices, if that's the cutting cycle, up decently on the high end of that range over the next 6 months. Look, when you have a Fed that is easing monetary policy, think about it. Look, I have a lot of money in short-term treasuries. Right now they're paying 4.25%. That's going to go down to 3.25%. And I'm going to say to myself, gosh, where am I going to put my money now? 3.25%. When you're talking 4 or 5%, now we're getting to some real returns. But think about what an investor is going to do. Interest rates go down. You say to yourself, I don't want to just earn 3% on my money. That's really not even beating the inflation rate. So you got to hunt for real returns in the stock market, which is our reason for existing here. So I will continue to hunt for places we can earn more than 3% because that is not fun. You're not going to do anything that way. You're just going to tread water for the rest of your lives. We have to ask ourselves now, where can we do better than that? And you know what? We will keep you informed on that. We have a lot of good ideas coming up. Anyway, that's all I have. Have a wonderful day, and I'll speak to you tomorrow.